We're jumping straight into EagleNXT today. And, well, if you've been watching the charts, you know exactly why.
Oh, yeah.
The stock has been on an absolute tear. We're talking a surge of, what, between 30 and 31.5%.
Right around there, yeah.
Yeah.
All driven by that U.S. Army order news.
Exactly. But if you're just looking at those daily gains, you might think the entire story is just that short-term contract momentum.
And that price action is huge, don't get me wrong. It's validation. But it is definitely not the full picture.
So what's the real story?
The real story, the thing we really need to pull out of the numbers for you, is that the contract is just the spark. The real fuel here is what's happening on the balance sheet.
Okay.
We're talking about a staggering 360% increase in the company's cash balance. This cash surge is aimed directly at scaling up their defense production to meet this new demand. That ability to scale. That's the biggest factor right now.
You're tuned in to the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
If you're enjoying the show, make sure to subscribe and hit the like button. It really helps the channel.
And definitely let us know in the comments which stock you want us to simplify next.
All right, let's look at the two sides of the EagleNXT story right now. There's a clear bull case and, a bear case to consider.
Let's start with the bull thesis then.
Yeah.
Which, as you said, really begins and ends with that balance sheet.
It has to.
That 360% increase, so some hard numbers on that. The cash balance surged from just, $3.61 million at the end of 2024 to a really robust $16.63 million as of September 30, 2025. That is a serious war chest for a company this size.
It is, and it's important to know where that came from. That was driven primarily by $12 million from selling Series G preferred stock.
And this isn't just a one-off financing round, is it?
No, and that's critical for investors to note. This round has the potential to get much, much bigger. We're talking up to $100 million, pending full shareholder approval. They're building a massive runway.
And it's a simple runway, too, because their existing debt is, pretty low.
Extremely low. Their long-term debt is only about $2.5 million. So this cash influx isn't going to service old debts or just, keep the lights on.
It's pure fuel.
Pure fuel. It's earmarked specifically for reinvestment, for scaling production to meet these defense contracts and building out those new distributor partnerships. This is offensive capital.
Offensive capital. I like that. But this is also where the bear case starts to creep in, right?
Yeah.
Because growth costs money.
It always does.
So if we look at the cost side, operating expenses are up.
Yeah.
We saw a 12.0% year-over-year increase. That's $3.91 million in Q3 2025.
And that increase is a direct result of them trying to scale. It's R&D, it's sales expansion.
Which I guess leads to the skeptical question, are they spending it efficiently?
That's the risk. You see companies take on big financing and just burn through it.
So how do we know this isn't just wasteful spending?
Well, we can look at their recent history. Just last year, in 2024, they were hyper-focused on cutting costs. They actually managed a massive 57.6% reduction in operating expenses. Yep. So the market seems to be interpreting this new 12% increase as a deliberate and necessary investment to capture this new market, not a return to old habits. They prove they can cut. Now they're trying to prove they can invest.
Okay, let's unpack the next really confusing point, which is the revenue. Because if you just glanced at the Q3 headlines, you'd probably run for the hills.
You absolutely would. And that's where most casual investors get tripped up. The overall Q3 revenue declined sharply. It was down 40% year over year to just $1.97 million.
A 40% drop. That looks terrible on the surface.
It does. But the details here are completely counterintuitive. You have to peel back the layers and look at their core business. The drone segment.
And the story there is different.
Completely different. The drone revenue for the first 9 months of 2025 actually increased by $1.38 million, hitting $6.03 million. Q2 growth in that segment alone was strong, at almost 24%.
So the one part of the business that actually matters for this new Army contract is accelerating.
Exactly. Investors are betting on the quality of that revenue over the overall quantity. They're shedding lower margin commercial sales to focus on these high-value, sticky government contracts.
So the big picture takeaway is that 2026 could be an inflection point.
That's the thesis. It's the point where that stable, defense-driven drone growth finally overtakes the legacy volatility. It's a strategic pivot.
Which brings us to the competitive mode. Why is EagleNXT the one winning these contracts? The drone space feels so crowded.
It is, but not in this specific niche. Their moat is built around their proprietary fixed-wing drones, like the EB TAC. This is not a hobbyist drone you buy online.
Right.
This thing is designed for serious reconnaissance. It has features like centimeter-level mapping accuracy and real stealth capabilities.
Centimeter-level accuracy. What does that actually mean in the field?
It's the difference between knowing a general area and pinpointing an exact target. It's mapping a hostile position with surgical precision. It's a level of situational awareness that consumer-grade hardware just can't provide.
But the real key, the thing that locks out the competition, is the compliance issue.
Absolutely. The critical factor is that it is NDAA compliant. And we really have to explain why this is such a huge deal.
Go for it.
The National Defense Authorization Act, the NDAA, it explicitly bans the U.S. Department of Defense from buying drones or even certain components from specific foreign companies, most notably Chinese companies like DJI.
So it's not just a preference for American-made, it's a legal barrier.
It's a giant regulatory wall. It completely blocks the biggest players in the commercial drone world from even competing for these U.S. defense sales. The Army order validates this position entirely.
And it's not just this one order. You mentioned they have quotes with the DLA.
Yes, the Defense Logistics Agency. It's the central procurement machine for the entire Department of Defense, and those quotes are valid all the way through January 2027.
So there's a clear runway for follow-up orders.
It's not a one-and-done deal. The Army contract is the validation, the DLA quote is the sustained opportunity. And now they're taking this compliant tech global through a new partnership with Falcon UAV in the Asia-Pacific.
And that market is enormous, something like $26 billion by 2030.
That's the projection. So you've got verified tech, a secure government path, and a huge pile of cash for global scaling. That's a powerful combination.
Okay, so how does this look on the charts, technically speaking?
Well, after that Army news, the stock clearly entered an accumulation phase. The big signal we're watching is the golden cross setup.
We hear that term all the time. What does it really mean here?
It's a powerful long-term signal. It's when the short-term 50-day moving average crosses up and over the long-term 200-day moving average. It suggests that the recent buying pressure is strong enough to change the fundamental long-term trend in the eyes of larger investors. The narrative is shifting from bearish to bullish.
So the technicals are confirming the thesis. Let's get specific then. What's on the catalyst calendar? What are the key events to watch in the next 3 months?
First up is earnings. Q4 and full-year results are expected late February, maybe March 2026. That's where we'll look for the first hard evidence of that drone revenue acceleration.
Okay, what's second?
The defense follow-up. We need to watch for confirmed orders from the DLA. Any news on that in the first half of 2026 would erase a lot of doubt.
And third?
The financial catalyst. The shareholder vote for the full $100 million Series G financing. If they get that, their cash position becomes just overwhelming. It gives them a massive buffer.
But let's bring the risks back in. They're still not profitable. They have ongoing losses, a negative PE ratio. Isn't there a real danger they just burn through this $16 million before those big contracts really start paying off?
That is the essential risk calculation here. They are an unprofitable growth company, but the market has already priced that in. The valuation is low, with a price-to-sales ratio around 1.16.
So the cash is a buffer against that exact risk.
Exactly. That $16.63 million is designed to manage those risks while they execute. It gives them time to bridge the gap until those big government contracts can deliver sustained profitability.
So that's the lowdown on EagleNXT for today. It's a fascinating setup, really.
It really is. It's an asymmetric opportunity. You've got a low valuation priced for current losses, but the company is sitting on this massive war chest with a verified, compliant product in a market where its biggest competitors are legally banned.
The entire investment thesis just pivots on the follow-through, on whether they can effectively deploy that cash to scale up before the cushion shrinks.
Which leaves you with a really interesting question. In a company like this, one that's transitioning into a secure government supply chain, what matters more? Is it the short-term profit and loss? Or is it the cash on hand to scale a proprietary compliant technology?
That's the big question to keep in mind. If you haven't already, subscribe so you don't miss our next breakdown. We'll catch you on the next one.